Hi, this is tradingstockforbeginners.com and this is an overview of reverse splits and share dilution. I'm going to be using DRYSHIPS as an example. It's an action in which a company reduces the total number of its tradable or outstanding shares by dividing its current share count by a number. A reverse split in itself does not add or remove any value to a shareholder. The same is true with any dividends. Dividends would be increased in proportion to the reverse split. So from a short-term point of view, the investor's value isn't changed at all. Could be to increase its share price because it's fallen so low there's a danger of being delisted from a major trading exchange, not meeting its minimum required share price. Could be to boost its stock price so major investors and mutual funds with minimum stock price rules such as $5 or $10 in place will see the stock as more attractive. Or it could be to boost its stock price to a level that enables it to transition from a penny stock to being listed on a major exchange, attracting the interest of more investors. That depends. Reverse splits have a negative connotation with traders because of the price drops that generally follow, the substantial price drops that generally follow. A lot of companies do reverse splits with good strategic reasons in place and the investors' interests at heart, but not all companies are like this. Take DRYSHIPS for instance. They've completed a ridiculous amount of reverse splits and don't seem to have any idea of stopping yet. Take a look at this lot. Share dilution is when a company issues new shares. This issue of new shares may reduce the value of the shares for any current shareholders. For example, say a company has 100 outstanding shares or shares that can be sold on the open market. Let's say you own 10 of those shares. That means you've got 10% of the business and the corresponding dividends and voting rights. If the company sells or dilutes its shares by a further 100, which are bought by others, now you only own 5% of the business and the corresponding future dividends and voting rights. Hence, the value of your shares has reduced. Simply put, for the most part, to raise money. New shares are sold on the public market and a company receives the capital produced by this. In a perfect world, companies would only do this to improve the company's profitability and ultimately give them time the value to the shareholders, but unfortunately, that is not always the case. Some companies sometimes give current investors additional shares to compensate for the dilution, but again, that is not always the case.